Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
I'm Guy Allard. Apparently we have our own brand of plain-spoken truth and common sense, unlike the Trump brand, right? Does that mean we're not PC? What does it mean when you have your own brand of plain-spoken truth?
Well, I didn't say it. We did those bumpers, and we really can't talk any other way. We didn't mention that part. So, well, welcome to the show, everybody. Today we're going to talk about the markets, interest rates, and what you can do right now. Remember, we developed this show a long time ago, many years ago, and it's to answer your financial questions. So much of the investing world starts, repeating the Greek alphabet to you to show you how much more they know than you do.
In an effort probably to confuse you, and
That's
you think,
right.
man, they must be smart.
They must be really smart when they could be the biggest morons in the world. There's no way to know.
Truth is, if you do anything day in or day out for 30 years, you ought to garner some knowledge, right?
Yeah, right. And we have 30 years each.
That's right.
And we've never have registered a complaint either, which is unheard of in this business.
Very rare.
So either we're really good guys, or
we do no business at all.
or we're very sneaky or something.
Something, yeah. That plain-spoken truth.
All right. The word on the street this week, a couple things. First, I'll briefly go over this. Doesn't affect people that much, but just wanted to know the Department of Labor rule has been struck down by the Fifth Circuit Court of Appeals.
That's right.
The right is heralding it as a great day because the DOL overreached. They should have been in the business. The SEC should be in the business. They were already there.
And, in fact, may end up doing something down the road.
The left is heralding it as they kept finding a appeals court till they could find one with the conservative judges that would blah, blah, blah. It is amazing how polarized everybody is. They don't trust judges, don't trust CIF, everything.
And the rule had the capsulized version, as it had to do with being a fiduciary for your clients. If you've heard the Ken Fisher commercials, that's his latest soundbite. I am a fiduciary. We put your needs ahead of ours, which is kind of the meaning of fiduciary. We are fiduciaries. We're a registered investment advisory firm. And if you want to boil it down to something, you want to have a fiduciary. You want somebody to be your advocate. You want somebody to put your interest before theirs, and that's what we do.
And the problem with the rule is, like I said, it was the wrong department bringing it out. Obama went to each of the different regulators.
As a shortcut, right?
They went to every regulator. They already said these guys are regulated enough.
That's right.
You can't have So the Department of Labor, which was run by Perez at the time, which is now the head of the DNC. Imagine how he got an upgrade, right? Because he said, I'll do it. And he put the rule out there. I understand theoretically, we're already fiduciaries, but I understand theoretically that someone should put your interest ahead of their own. The negative aspect of that is a lot of smaller investors, since there's so much, basically they open up to the lawyers. Remember, everything used to be arbitration. If you had a problem with your broker, you went to arbitration.
Very litigious.
Well, the Democrats wanted the lawyers to get in there so they'd even get more protection in their mind. The problem with that is every client's going to have a certain amount of liability. And if you can't make any money because you got to charge 1% or whatever, a uniform deal, with somebody under, say, $500,000, people quit servicing them. England did this same kind of rule probably 10 years ago now.
That's correct.
And nobody will touch an account under $500,000. So
it doesn't generate enough to merit their attention. So
the theory is good. Let's get some kind of fiduciary rule for everybody. But in the unintended consequence is the people you're trying to protect, which was the littler people, are the ones now don't get any advice. And so that's where some of the issues were. Now, some people don't need advice, right? They're doing pretty good on their own.
Well, and
but most people do.
Usually the people that need the most protection and a fiduciary are the little people, right? If you have a lot of money, the accredited, unaccredited investor, one of the ways you can become accredited or they kind of knowledgeable is having a lot of money. They assume, and with a fair bit of certainty, that if you've acquired that much, amassed that much wealth, you've got some intelligence, you know what you're doing, you don't get taken advantage of as much. So again, the consequences in trying to shortcut as they did hurts the people that the rule's supposed to help.
I mean, like I said, I'm a right-wing guy, but the intention for like Obamacare was to insure the people that weren't insured. The problem was the unintended consequence of that, it raised the rates for the 95% of people that were insured. And that's the problem with regulations. They could do either way. But now apparently the SEC has taken up the moniker, and they'll do it the right way because they're the ones that regulate the industry in the first place. They're the ones that actually have enforcing power when the DOL really didn't. The DOL said this is a rule, but if you break this rule, then the lawyers can sue you for the plaintiff. And that was so when you bring that in, that makes the cost go really up. And so that's why I'm glad it got shot down, not fiduciary. They'll come up with a different one from the SEC, but it allows people with under $500,000 to still get service.
Well, and also it allows and smaller is not necessarily the word because of assets under management, but boutique firms, it doesn't hurt them. The rule hurt the smaller boutique firms because the large wirehouses were geared up for it. They have the deepest pockets, and they were getting behind it full speed
because they eliminate their competition.
It's eliminating a lot of the competition, right. Absolutely.
And so and you need competition to have fair anything.
Keep an honest man honest?
That's right.
That's right.
So that's for that. Now, the other big news this week on Wednesday, they raised the Fed funds rate a quarter of a point, and it's right now between 1.5, 1.75. I can't remember now. It's 1 point. Well, they're going to raise it. Oh, it's between. They always have this. Remember, it was 0 to 0.25 is the lowest, but they've raised it 3 or 4 times. They expect to raise it a quarter point, like 3 times a year, 2 to 3 times a year. They're going to get it up to, I think, 3.4 by 2020. Okay?
And don't be afraid of that. You have to prepare and keep your stuff balanced.
So what does that mean for stocks? When it gets to 3.4, CDs will be paying more. More people will drift over to CDs. Like I said, if there was a 7% CD right now at the bank downstairs, there'd be a line from here to Houston.
Yeah.
So when that happens, more people will drift out of stocks into into CDs. But what happens to bonds? Well, interest rates go up, bonds go down. Here's why. You've got
current bonds.
Yeah, you bought a bond 2 years ago when Fed funds rate was 0, and you were getting, say, 4% or 3%. Well, who wants your 3% bonds when I can get brand new bonds for 4.5%? Nobody, unless the price drops. So the price has to drop to show the equivalent yield the same as the new ones.
So if you need that money, if you want to use it, if you want it to be liquid, then you have to sell that 3%. You have to discount it because a new person could go out and buy a 3.25% or 4% bond. So the only time it affects you, you'll still get your 3%. But if you need to liquidate that money, if you need to get to it, that's when you get hurt.
And the common misconception is well, if I just hold it to maturity, it'll give me my principal. That's true. But you'll still miss out for those years of the new rates as they're increasing.
Absolutely.
So it's almost even. Taking the loss and getting the new rate, it should be close to even. The arbitrage guys will make it pretty dang close to even.
That's right. That's what they do for a living.
That's right. So no matter what, if you sold it early or you held it to maturity, your yield's going to be real similar. That's the problem with buying bonds now. But the problem with some people say, I'll just stay out of bonds. Okay, well, you can stay out of bonds. The problem is nobody in their right mind is going to be 100% stocks when you're 60 years old. Don't get me wrong, people do it all the time. I'm talking about your right mind. If you're knowledgeable, you got to have some fixed income. Now, that fixed income doesn't have to be bonds. It can be CDs, money markets, fixed annuities. It can be different things like that. The one thing it can't be, because everybody always tries to put it as a dividend-producing stock, or like right now when real estate's done so well, they'll have it in REITs, real estate investment trusts. Those aren't really true fixed income. You need some safe fixed incomes. What happened is if you put it in a REIT, you not only can lose the interest it's paying, or
you may not get your money back.
You may not get your money back at all.
It's hard to get it out.
So it has more than interest rate risk. It's got default risk as well. So
and some of the peripheral things, if you've got a large purchase coming that you're going to finance, let's say a house, sooner is probably better than later. Obviously, if it's 1.5% more in a year or two, it's not a deal breaker for you. But if you know now, and you do know now, it might be a good idea to accelerate that decision.
Yeah, buying the houses are definitely going to get more expensive because 90%, or I'd say 99% of America does not buy the price of a house.
I was thinking the same thing. That's right. They're buying a payment.
And so what'll happen is the payment's just going to go up on the exact same house.
Remember when when the California was the real estate was so expensive, the loans originated out of California, and of course they made it their way east to us. But they were interest-only loans. You had a 5-year balloon where you had to either refinance or do something.
And the reason why they're collapsed is they had about 140% of your value.
That's right.
Up to 140% because the value is going up so much.
That's right.
Bank said, all right, you want $1 million? I'll give you $1 million for. And they were given too much. Now, in Texas, we never had that. It was always 80.
I had a couple friends, didn't you, that did interest-only loans, and you just kind of shake your head. You can't afford the house. Why are you buying? What's it going to be like in 5 years when the balloons do?
Well, when the interest rates go up, you'll see the same thing.
Yeah, that's right.
Because people buy payments.
That's right.
I mean, there's only maybe 5% of homes that are sold for cash. Most of them are sold for payments. And that's what, I remember like the house I had in Plano years ago. It wasn't, the payments are lower now in that house, and the dang house is worth 50-60% more.
I've never done a variable rate, have you?
No.
I know a lot of folks will do that to save a little bit up front.
And some of the variable people, because the rate stayed low so long, actually made out.
Yeah, they did okay.
My last mortgage guy tried to talk me into it. It wouldn't end up bad. My brother-in-law did it. It didn't end up too bad because interest rates stayed so low, so his payment was virtually nothing. When he actually did finance to a 30, his payment actually went up.
When you refinance?
Yeah, but you're paying principal then, even though the first 5 or 10 years you're barely paying any, right?
That's right.
So those consumer advocates like Ramsey and stuff like that, they're right. If you put that extra payment in every year, little bit a year, or you do reduce
it
bi-weekly
instead of monthly.
Yeah. All kinds of tricks you can do for that. Now let's talk about investments. So here's one of the common mistakes a lot of investors make when it comes to interest rates going up. We know bonds are probably a no-no for a while. It was proven by that Ibbotson report Roger Ibbotson did a while back. We're going to talk about that. They did in January.
You've just ruined the bond market now.
Yeah.
You watch tomorrow.
Yeah. So bonds, but let's say if interest rates are going up, here's a common tendency. Well, I'm going to wait till they get up to 4%. They're 1% now on a 1-year CD. Well, I'm just going to wait 3 or 4 years because they said they're going to raise the Fed funds rate. And that's correct. But there was always a lag time. Just remember that. But let's assume for this example, there's no lag time. So the first year, you're going to keep it in a 1-year CDs, and you're just going to keep that going. First year, you get 1%. Let's say next year you can get 2%. And the third year, we're going into 2020 now, right? It's going to pay 4%.
Got it.
Well, if you did all of that over the 5-year period, let's say you're at $100,000, it's worth about $115,883.
1, 2, and 4.
If you didn't pay tax on it. If you pay tax on it, it's going to be considerably less. But why not? You could right now pick up just a MYGA, 3.5% for 5 years, and you'd have $118,769. So it does not pay to wait when you're in a rising interest rate environment. Now, what it does, once it's 5 years is up, then you can go back to something like that. It's fine.
And the acronym for MYGA, if you're not in the business every day, is a multiple-year guaranteed annuity.
And they're also called CD annuities because it basically just gives you a rate.
But I tell you what, a lot of them, and you don't find, some CDs, but mostly not, you'll have access to 10% of your money each year, not just the interest. There's some benefits to it as well.
Oh, yeah.
But the rate now for 5 years, roughly
3.5 for 5 years.
Yep.
Which I never thought would be great, but it's pretty good.
All right, so
try to beat it at the bank.
5 years at 3.5 is out of 100.
Oh, it comes out to $118,769. It's about 15% more than the CD if you could pay no taxes on the CD.
Got it.
Since one is tax deferred and one is taxable, you're talking about 50-60% more interest than waiting for rates to go up. Just pick a good rate now, hold it for that 5 years, and then go from there. Because you can't, everybody does this all the time. They go. And I've had customers keeping money in money markets, earning nothing on it for 10-plus years waiting for interest rate to go down. Because this is the Fed's plan right now. The Fed's plan can change.
People do that in the stock market, waiting. I'm not going to get out. My account's too far down. I got to wait till it come back.
It's analysis paralysis.
Yep.
I love stocks. But the problem with stocks is if you get emotional with them, if they're going up, you can't sell them. Well, I'm not selling that thing. Made 20% last year. They'd be nuts. Well, if it's going down, well, I can't sell it now. It's going down. When it gets back to even, I'm out. I promise you this time. And it gets back to even, well, hell, it made so much lately. CDs aren't paying anything. What happens, though, when CDs are paying 4%? People started going to CDs.
That's right.
It's just the way it is. Remember, the market's only made 5.27 this century. 5.27.
The easiest way through that minefield and to avoid the psychology and the, all of that from not getting out and being afraid to get in is just keep your portfolio balanced. Have it in your mind. We call it a mechanical, meaning certain things happen and you do A. If this happens, you do B. If you have it all written down and you keep it balanced, it makes it easier for you.
There's one thing that I was talking to a client this last week, and it brought up something. I was telling him, about the Ibbotson report. Roger Ibbotson is one of the biggest pro-stock people in the world. He's a Yale professor. I mean, a huge pro-stock. He invented the Ibbotson charts that shows the stocks have beaten everything in the world. He was concerned with interest rates when the Fed funds rate got to nothing and knows it's got to go up from there. He was concerned about bonds. He goes, I know I need a 50-50 stock portfolio, bond portfolio. But what am I going to do with that 50% bond side if I know they're probably going to lose money or make very little? So then he put in index annuities in those. These are the uncapped index annuities. These are more for growth than income. So this wouldn't be in your income bucket. Remember you've talked about our 3 buckets? You got your safety bucket. You got your income bucket. Then you got the growth bucket. The growth bucket's got part liquidity, part growth above inflation, because nothing beats the stock market long term, beats inflation more than the stock market. So you got to have a piece of that too. Let me take that back. If you're some billionaire and you don't want any stocks, you don't have to have anything.
Tax-free bonds, baby. That's right, and you'll be set.
When you got that kind of money,
that's right.
It doesn't matter that much. But for normal people, that's what we're talking about. But that fixed income piece, remember, let's say you've already got your income numbers. You got a pension or Social Security and some annuity income, whatever. But either one of all your income bucket more than pays your expenses. You still got some more that you're going to have safe. Otherwise, your allocation's out of whack. In other words, you're the guy that ended up with 90% tech stocks when it dropped to 80% back in 2000. You don't want to be that guy or that girl. So you got to have that fixed income piece. We talked about this before. Some of these uncapped strategies they have now, you can get 100% of an index, like some of them are the J.P. Morgan Mosaic Index, several Barclays indexes. Now, what these are dynamic indexes. It's a little different than a static index. In other words, they could change the allocation stocks and bonds if they need to or want to. They can move it out of bonds and put it in cash for a certain period if like bonds are looking bad. So it's more a dynamic kind of index. But let's say it was a 50-50 index, like a mutual fund that had 50% stocks, 50% bonds.
Right.
It will allow you to get up to 100%, even sometimes 110, 120% of that index, but are guaranteed you'll never take a down year.
That's right.
It's guaranteed not to take a down year, period. I don't care if the market drops 80%. You cannot lose a penny. So they take that instead of the bonds. And remember we just said bonds are probably going to earn this to this, right? You take that, and every single scenario, what it did was it increased your return and it lowered your risk. Every single time. The only time it didn't is when bonds got really high, when bonds were paying like 8 or 9%, and they were going down. Remember? So bonds will I'm sorry, the other way. They always beat it unless bonds were just killing it. Interest rates going down makes bonds go up, right? But right now, interest rates are going to go up. And so, sorry, I'm trying not to confuse.
The bond itself will, if new bonds will make more money than the old bonds. But again, when you try to sell or liquidate is where you get hurt.
Right. What you've got is now part of that Ibbotson report. Remember, you could call us. I can send you a copy of this. It's a very detailed report by a Yale professor that shows you might want to look at alternatives to bonds for that fixed income piece. And we're not talking about just money markets. Money market is an alternative. They're just not going to pay you anything. So you got to get some kind of yield on your money.
And you already have that bucket. That's your liquidity bucket where you're not getting paid much on.
That's
so
right.
You don't want to combine your income bucket or your stock market growth bucket with that bucket.
So part of his study said, okay, what if interest rates are rising over a 3-year period? Well, that's exactly what we're talking about. The Fed has been raising them for about a year. And they've got 2 more years of raises to get us to 2020. They started in 2017. So it's a perfect scenario here. They've got 3 years worth of raising, okay? And so what they did was they did part of the study. They did a study on a 1% increase over 3 years too, but they actually have a 3, which that's about what we're talking about here. It actually might be up 3.5. But let's say the interest rates increased 3%. Well, here's what would happen to your average bond portfolio, treasury bond portfolio. It'd lose about 5%, 4.8%. If stocks, no matter what stocks did, stocks could make 20% a year, stocks could lose 20% a year. It always lost about 4.8% over that 3-year period. 4.8% a year. Okay? If you had the index annuity, market made 10%, it'd make 3.7 a year. So if the stocks are doing well, you're making income, but you're not losing 5% a year. Now, here's the difference. You're not going to be all bonds or all stocks probably. You're probably a combination. So let's use a 60-40 portfolio.
It's a good
portfolio. We know the bonds are going to lose money over 3 years because interest rates are going up. We know, and let's assume stocks are going to make 10% a year for the 3 years. Good return, right?
Yep.
Well, you'd make about 4.1% on that stock and bond portfolio. Not too bad. Remember, one's hedging the other, all that kind of stuff.
Absolutely.
But if you just switched it, instead of the 40% bonds, put it 40% index annuities with the no-cap growth ones, you made 7.5%.
Substantial difference.
That's right. It's almost 100%.
That's right.
100% increase. It eliminated your risk on the fixed income piece, and it raised your return almost 100%. Normally, it's not that drastic. If interest rates are going up, say, 1-2% a year over 3 years.
No, but this is the climate, the environment we're going into right now. We're looking at 3 years over time to raise the rates and possibly up to 3%. They also talked about their quantitative tightening, in other words, reducing their inventory of bonds, which they started last fall, and that's working out well for them too. And that's going to put a little bit of a brakes on things too.
Right. What you've got is like, here's what the returns have been long term. And by the way, what we're talking about is what do you do with the safe part of your portfolio, the safer part. In the old days, you had stocks and you had bonds. The bonds would hedge the stocks, right? Right now, we're in a rising interest rate environment, and the market is topping out. You got a PE ratio of 31, or Shiller PE ratio of 31, which your returns for the next 10 years, 15 years usually aren't good historically.
We went through that last week.
That's right. So we have a double whammy situation. In other words, if interest rates go up and the stock market goes down, I'm losing on both. I don't have a hedge.
Painful.
I've got a double loser. And so you need to at least get one of those because your stocks, not much you can do about it, right? But your fixed income piece, why don't you just get a better return on the thing and eliminate that interest rate risk? So let me tell you what the long-term government bonds have averaged, and this is since 1927, 5.43% a year. What would the index annuities would have made? 5.98% a year. Stocks, 10.63. And so long-term, you didn't lose any return, right? But remember what it does when the interest rates are going up. It destroys. It almost doubled the return of your portfolio just by getting rid of the bond piece and adding like an index annuity piece to it. Now, CDs work for this too. They're just not paying enough. You just need something that's not interest rate sensitive.
I'm sitting here listening to you go through this, and it's all true and makes sense. We've talked about it before, but I got to tell you, and it's maybe because it's subjective, but what flashes across my mind is all the people I see advertising that fixed annuities are not the way to do it, and if you want to do it, there's a better way to do it. And this is Ibbotson talking about it, who's a stock market guy, stocks and bonds, his charts, his information. So again, if someone is categorically telling you not to do something, they usually have their own agenda.
Yeah, the problem is they're selling a competing product. That's what I always tell people. I've told this to listeners, clients. I said, for every person like that says you shouldn't do it, I'll give you a Nobel Prize winner, Ivy League professor that says you should. They have no skin in the game. They don't sell annuities.
And they're not spending $1 million a week in advertising to get in front of you.
That's right. And the reason Ibbotson is so good, because he's the father of the stocks beat everything.
That's right.
So he's not saying the stocks. In other words, what you've got is like Ken Fisher saying stocks are the only way, I'm blah, 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 blah. The other guys say annuities are the only way, stock market's a casino. They're both wrong. I go, but what about the intellectuals? The people that have no skin in the game either way. Even though this is a pro stock guy, they go, hey, the numbers don't lie.
And this is the hard-hitting, plain-spoken truth that you hear the bumper on the beginning of the show. What we would ask, unlike network television, CNN and Fox News and politicians and all of that stuff, we just ask you to use some common sense. Look into it for yourself. See what makes sense.
Yeah. What we'll do is don't hesitate to call us. We'll send you a copy of this report. And if you want the returns, like right now, you can get one. The worst that I've ever done is about 5.69% a year. The best is about 7.4. So think about it. You got bonds that can't make money right now. The best 10-year bonds right now about 3%, 4%, right? So the best you can make is 4 if the interest rates don't go up.
That's right.
Well, the government's already said we're going to raise them. So, but why not turn that into that max 3 or 4 into 5 to 7?
Now, if you know of a bond that's paying 6 or 7, it's probably Illinois bond or Chicago bond or anyway, one that comes with risk. It's not a guaranteed number.
That's the problem we have also. I've got people saying, no, I don't know. I got a bond fund pays 5 or 6, has for years.
Bond
you
fund.
Don't realize that bond has extra risk. The risk we're giving you was on safe bonds.
That's right.
The risk on a really long bond or a corporate bond that's not investment grade, the risk is 300 to 400% more than a safe bond.
Or some of these weak, poor, broke municipalities.
Right. So think about it. We just told you if interest rates go up 3% a year, the numbers show long-term government bonds will lose about 5% a year, 4.8% a year. What do you think it would be if you have a bond fund that has long bonds in it and junk bonds in it? Or, I'm sorry, high-yield bonds.
Well, they have high-yield junk bonds, right, so that it enhances the
That's
fund.
right, because they got to compete with everybody. Who wants to buy a bond fund paying 2%, right?
That's right.
They want the one paying 5%.
That's right.
You just don't realize half of it's junk in there, or it's high yield.
Yeah. That's right.
And so those get killed the worst. It's not like you lose 5 on this and you lose 7 on a junk. It's 2 or 3 times as much. You lose 15, 20.
Yeah.
On high yield and long-term bonds in comparison to a 10-year treasury.
Absolutely.
So there's a lot more risk. And like I said, we'll send you our number is 972-715. We got electronic copy you can have, 972-715-2424. You always go to our website, ilovemyretirement.com. But you take this report and you look at the average returns, and it's a way better solution to consider than your current, I'm going for the bond fund and the 401k, I'm doing this individual bonds or whatever. I'm going to read the conclusion to this study, and like I said, you can have your own copy. But it says, we began with conventional wisdom. Stocks beat bonds by a wide margin. Remember, these are the pro stock guys writing this report. Stocks are riskier than bonds. As we approach retirement, it is prudent to de-risk portfolios and shift greater allocation towards bond-like investments, right? This is what everybody should do. That's conventional wisdom.
That's right.
Although we believe this wisdom still to be true, we caution individuals preparing for or in retirement not to become complacent, particularly in this low interest rate environment. Each person's goal and risk tolerances are different, and there should be other options to consider. Annuities have for a long time deserved a place in people's retirement portfolios, and the evolution of the industry has made these vehicles more flexible and more attractive. Remember, we're from the stock world. For a long time, we hated annuities. And honestly, they weren't that user-friendly. They were the variable annuity type where 90% annuities sold, and the fees were too high. I can't recommend high fees to anybody.
We both were commodities.
But that's what I'm saying. They've made them very more flexible, much more attractive. I think baby boomers getting to retirement age changed everything, because baby boomers, a lot of times, are more educated on things, and they're not willing to pay big fees. And they understand that that's going to eat up your return over time. But it says, as with any investment, working with a trusted advisor and doing your own due diligence is key. It says fixed index annuities have many attractive features as both accumulation investment and a potential source of income in retirement. In simulation, the index annuity performed better net of assumed fees than long-term government bonds. We showed the FIA had comparable volatility to bonds, but with better downside protection. In our study, when bonds underperformed, the FIA could perform quite well. In our view, considering today's low interest rate environment with modest expectations, FIAs are the alternative to consider. That's our show, folks. Don't hesitate to call us at 972-715-2424, or you can go to ilovemyretirement.com. I'm Victor McClure for Guy Allard. We always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.